Hello, everyone. Today on the Final Bar, we'll wrap the week as we do every Friday. We'll look back at the week that just occurred. What did we learn? What changed? What's different? Certain things did, particularly the improvement in breadth, but overall, a lot of similar themes. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in these markets using the power of technical analysis. The technical toolkit is really designed to help you understand what's happening, not understand necessarily why, the cause and effect of what's going on, but really to focus on the evidence, right? The evidence in terms of price behavior. We can debate endlessly what investors are thinking, if they're excited, if they're nervous, if they're panicked, if they're optimistic, pessimistic, if fear or greed are taking control. Arguably, price is the best way to measure all of those adjectives I just described because it helps us measure how investors are voting with their capital. And that's why technical analysis should be such an important part of your toolkit. We hope to help you along that way of making sense of things. When we look at the markets here on a Friday, sort of a choppy session, but I think when you look at the overall sort of weight of evidence of this week, sort of bringing into question the mega cap growth themes that have become such a part of 2023. A lot of my guest conversations this week have been talking about bit of mean reversion, some of those leading stocks pulling back, some of the lagging stocks starting to improve. What happened today? How does that fit into that narrative? Let's go through it together. We'll start with our Wrap the Week segment. I like to do this every Friday, just looking back at Friday to start with, and we'll dig into some of the weekly returns and then look at some of the larger themes and charts I think that tell the story. First, though, I do want to get to our poll. We asked you recently on our YouTube channel, our social media accounts, and elsewhere, will the next 10% move in the S&P 500 be higher or lower? 65% of you answered higher. So a 2-to-1 ratio of bulls over bears just based on that particular metric. You know, what's interesting is if you actually look at a chart of the S&P 500, what would a 10% move actually mean? Let's actually bring in a little more data. And we'll look at 10% up and 10% down. I could do the quick math, of course, but why do that when you can actually use the StockCharts platform and make that happen very easily? So 10% above current levels takes us to right around 4730, we'll call it. That's a rounding error away from all-time highs. So, boy, 2 out of 3 of you are saying we're going to get there next before we get here, which is basically down to 3870, we'll call it, which would essentially be a retest of the March lows. That's actually a little bit surprising to me. Certainly a lot of optimism because of how the market is rallying up to that 4,300 level, really testing that resistance. I think it's still an open question as to whether we're able to power above that resistance level or not. A lot of my debates and discussions with guests this week have been on the likelihood of us sort of eclipsing that level. But let's not forget about the downside risk, right? One of the challenges, or I think one of the great benefits of technical analysis is thinking of things in terms of risk reward. What's my upside potential? What's my downside potential on any trade? And what a betting man or a trader will tell you, you really want to make sure that the odds are in your favor as much as possible. When you're looking at the S&P, what's the upside potential, right? What do you see going beyond here versus the downside potential? And what's challenging to me in terms of we're obviously going to retest all-time highs sort of thesis is we're just one bad inflation number away, or one strong inflation number away from, I think, risk being taken off the table very, very quickly. All of a sudden, those March lows get a lot closer once we start to rotate lower. Thanks for answering that poll, though. Interesting to see how we become a little more bullish as the market has started to improve a little bit. Let's look at what happened today. Not much of a change by the time things were said and done. The S&P pushed above 4,300 and then closed back below it. And I feel like I've said something along those lines a lot over the last week or two. We've reached 4,300. We've reached this big pink shaded area on my S&P chart. We have yet, given a lot of opportunities to push above there, we have not quite done it. We finished the week below 4,300 yet again. So I think once again reinforcing the importance of this and the significance of this resistance level. The Nasdaq Composite about the same, up about 0.2%. Mid caps and small caps both pulling back today, with the S&P 600 small cap index down about 0.8%. The VIX actually popping higher a little bit, but not by much. Still below 14 and still very low relative to what we've experienced here over the last year and a half. Quickly, let's look at some other asset classes here. Interest rates, for the most part, moving higher. 5, 10, and 30-year points all pushing higher. 10-year yield finishing the week around 375. The 5-year point actually getting closer and closer to 4%, and the long bond yield just below 3.9%. Dollar index about 1/3% higher from yesterday. Not too much change. All red in commodities, but not end of the world red, just more slightly red. We don't really have gradients on this to show you whether it's really bad or just kind of bad. It's sort of a binary thing. So they're all in the red, but not a horrible day. Gold and silver both down a bit. Copper prices a rounding error from yesterday's close. Not any significant movements. Same for cryptocurrencies. Bitcoin has actually been a pretty choppy trade here over the last 48 hours or so. Currently around 26,430. That's down about 1/3% from yesterday. Ether prices just above 1830. You can see the rest mixed, maybe net negative, but overall not a lot of movement there. In terms of sector movements here on Friday, tech and consumer discretionary, XLK and XLY at the top of the list, both up about 0.5%, followed by healthcare. Everything else was flat to down. And at the bottom of the list, we have materials down 0.8%, and then utilities and real estate down about 0.6% each. Let's go to the wrap the week chart. This is looking at the last 5 trading days and just seeing how markets have evolved from last Friday's close on June 2nd to this Friday's close here on June 9th. The black line here, if you follow my voice and the mouse, you'll see where we're at. The S&P 500 really chopping around through the most of this week. Again, I feel like the overall trajectory has been this rally up to 4,300, and now we've sort of stalled out, what we call a power on stall, just sort of holding steady right about this level, no longer going higher, but not really coming down. We're sort of still waiting and seeing. We're treading water to see if there's enough upside momentum to push us through resistance instead of just to resistance. So the end of the week, with today and yesterday's rally, the S&P finishing up about 0.5%. Gold was up just a slightly higher, around 0.6% for the week. In orange, emerging markets up 1.6%. In purple, we have small caps up 1.9%. Everything else was actually underperforming the S&P and down for the week. Flat for the week, to be honest with you. Bond prices basically down 0.1%, so essentially a wash. The Nasdaq 100 as well, flat for this week. Now, as of Wednesday, pretty weak, but then sort of bounced higher. I mean, a pretty low move for the week, and then bounced higher over the last couple days. In green, we have the dollar, the UUP, which was down 0.3%. In brown, this is actually crude oil using the USO, was down almost 2%. Bitcoin finishing the week down 3%, but again, a pretty choppy week, ending up not too much of a change from last Friday's close. If we look at these two charts here, these are what I call just the main dashboard charts that I have here. No change in our market trend model. So long-term, medium-term, short-term, all remaining bullish. That has been the story since late, February into March is when they all sort of completed the rotation bullish. At the end of March was when the long-term model finally turned bullish. And now in all 3 timeframes for me, it's bullish, and that is exactly how the chart would look. If you asked me to just look and give a subjective assessment, it's pretty much what I'd answer. So, let's be clear. The trend in the major averages remains strong, even though we've stalled out a little bit. Now, while the S&P is breaking above 4,200, now testing the August highs at 4,300, let's remember that the advanced decline line, even though a nice June so far, first week and a half here in the month of June, pushing to the upside, but the advanced decline line is still well below its February high. It's actually still below its April peak. So while the S&P has gone from the April peak to where we're at now, the advanced decline data is actually weaker over that time. Over 50% of the S&P members are above their 50-day moving average. That's encouraging. As long as it remains above 50% on any pullback, that tells you the conditions are pretty strong. About 56% of the S&P stocks in a bullish point and figure chart, which is encouraging as well. Out of all the charts that I just mentioned, I think the most important series is the series here at the bottom, which is the relative performance of the equal-weighted consumer discretionary versus equal-weighted consumer staples. Are investors rotating more into things you want or things you need? This line is going higher. That tells you more offense over defense. If what I just said does not make sense, on my YouTube channel called Market Misbehavior, I just posted a video yesterday focusing on that ratio and why it turning higher could be one of the most encouraging signs that we're seeing. So check that out if you like. Finishing off here with a chart or two before we take a break, I wanted to highlight the fact that Netflix is gapping higher yet again today. Netflix up 2.6%, which is a nice upward, nice gap to finish the week. Trading lower through the course of the day, but overall a nice week finishing at 420. Now this is after we rallied up to 400. 375 was the resistance here in February, the resistance again in May. We pulled back from that level and then broke above there a couple weeks ago. From there, we've sort of dribbled higher. We're overbought right now, which tells you just simply that the trend has been very, very strong. Look to see when we come out of that overbought range. A lot of times that can tell you about a little bit of a pullback likely occurring, but overall trend is strong, momentum is strong, and relative strength is strong. This is a foreshadowing to a question I'm going to highlight after the break about what a good chart might look like. But that's the chart of Netflix. Biggest gainer in the S&P today was Match.com, or the Match Group, MTCH. And what's interesting is this is why I think it's always important to not just look at one day's returns. It's easy to see something like Match up 6.5% and think, wow, that's huge. What a big gain. How did I miss that? But let's take a big step back from the monitor and look at what the last 2 years have been like for the Match Group. Now, we have certainly broken above the 50-day moving average. That's not a bad thing. That's usually a good sign when that happens. The last time we had this kind of move was in December of last year, January of this year. We stalled out a couple points, so maybe 10 points, we'll say, above the 50-day moving average, and then we rolled back over. So I think watch to see how far we're getting away from there. You'll notice we broke above the 50-day, and we were overbought in January. We never made it to the 200-day. We rolled over, and when we became overbought and then rolled out of that overbought region, that was the indication that this was maybe a sellable peak. Look to see what happens now. We're testing a big resistance level in the form of the 200-day moving average. Match was last above its 200-day back in November of 2021. So we've been in an established downtrend for quite some time. I think for a lot of investors, the question is, when does this chart prove itself as more of a bullish rotation? If you're more of a short-term swing trader type, maybe this has been enough where you've seen enough of a break above previous resistance. I would love to see a break above the 200-day. I would love to see a higher low on a pullback, which is one thing we have certainly not seen yet. Let's take a quick commercial break, everyone. We'll be back in a minute answering your questions from the Final Bar mailbag. We'll see you in a minute. Hey, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thank you so much for joining us every weekday after the close. We're excited to update you on what the markets are doing through the language of charting, which I would argue, again, is one of the best ways to just try to make sense of what's happening around you as an investor. A couple quick announcements before we bring on the Final Bar mailbag. First off, we welcome your questions. The mailbag that you're about to witness is all fueled from questions from people like you over the last couple days. Keep them coming. Our email is thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV. And remember, you're watching us on YouTube. Put a comment below the video that you're watching. We'll gather all those questions and hope to answer your question live on the air Monday show of next week. Speaking of next week, a couple really good guests. It's an important week, of course. We have inflation data on Tuesday. We have the Fed meeting on Wednesday. Gina Martin-Adams, who's the chief strategist at Bloomberg Intelligence, is going to be joining us on Tuesday. She is awesome. She is really smart, knows the markets, knows the economic conditions. I cannot wait to pick her brain on what's going on. Fed Day on Wednesday. We're working on a good guest to help debrief on what we heard there. And then Doug Ramsey, who's the chief investment officer at Luthol Group from Minneapolis, is going to join us on Thursday. Let us move on here and open the Final Bar mailbag. Again, thanks for all of your great questions. And here is question number one. Dave, how do you reconcile such contrasting forecasts by your guests who are all great CMTs? I love this question so much. And I will tell you, one of my favorite things we used to do when I was working as an institutional investor at Fidelity up in Boston, we would have the opportunity to talk with a lot of different technical analysts, a lot of fundamental analysts, a lot of macro strategists. And at the end of a couple of weeks, we would compare notes. Who talked to who was bullish, who was bearish, what were they seeing, what were they seeing that we're not, what are they thinking about that we think is maybe more or less important. And it was a great way to just sort of test our own investment thesis and challenge it. That, in a lot of ways, is what we're trying to do with the guests we bring through StockCharts TV. If every one of them was thinking the exact same way I was, and if they're showing you the same charts, wouldn't be a lot of value in having guests. So I think having someone like Tom Bowley, who's been fairly constructive on the markets, to really understand what the bear or what the bull case is and what is fueling that optimism. What is he seeing? What charts are really speaking to him at any given moment? Someone like Jeff Hughes, you mentioned in your longer question, pretty bearish right now, right? And seeing all the challenges that we've suggested about limited upside, but almost unlimited downside, and what that downside move may actually hold. Once you learn the technical toolkit, it's just like learning a language. Just because we both know English or both know Spanish doesn't mean we're using that language in the same way, because we might have a different life experience, different biases, and different baggage that we might be bringing with us, and that sort of informs and maybe clouds our opinion at different times. That is what happens for technical analysts. We all have a CMT, or many of us do, which means we've learned the toolkit. How we apply that toolkit, what our charts look like, and how we interpret them is what is subtly different between, and sometimes not so subtly different. So I would say one of the great things we try to do is show you the charts that our guests are using. We actually allow them to show their exact charts. These are from their desktops, and this is what they are using. And I think that's a great way to try to get inside the head of all these smart people and see what is fueling their bull and bear decisions. So I think the fact that you've picked up on those contrasting forecasts means we're doing our job and giving you some diverse opinions. And I hope you find that helps nudge your own thinking. Next question. You often say, quote, "That's a good looking chart." What should we look for to make that determination? I feel a little cringy at that if I do say that, because I don't want to just leave it at that. I don't want to just say this is a good chart, right? I always want to give you a little more detail, but I'm sure in the heat of the moment, I probably say, well, this is a strong chart or a weak chart. So what does that mean? I'll give you the quick answer, and then I'll tell you in a moment where you can find the somewhat longer and more detailed answer. For me, it comes down to a couple different measures, and I think it comes down to trend and momentum, right? What is this stock doing or this ETF doing, and how can I qualify that by looking at different indicators and different ways of supporting or denying what I'm seeing in the chart? I'm showing you a chart here of Apple just to show you an example of a chart that, for lack of a better term, that's a good-looking chart. So what is it about this chart that looks constructive? So again, it comes back, it always starts with Charles Dow, and he, again, the father of technical analysis, early 1900s, wrote a series of essays where he described price behavior, basically talked about indexes. A lot of what he did we now call Dow theory, and that's what you're taught when you first learn the CMT. The level one of the CMT is all about Charles Dow and the basic fundamental building blocks of technical analysis. And it starts with trend, right? Are the highs getting higher? Are the lows getting higher? And that's why I often try to repeat that. Higher highs and higher lows, or lower lows and lower highs. So the first thing for me is, where is the price? Are the highs getting higher? Are the lows getting higher? Where's the price relative to moving averages? And a good-looking chart summary for me is the price is going higher and it's above two upward sloping moving averages. Other things like the momentum characteristics, like the relative strength, like volume, like indicators such as PPO or MACD or RSI, on balance volume, or the Chaikin money flow. These are all ways of further validating what you saw first. But for me, it starts with price. That is fact. And that is what's most important to analyze. Now, that's the short answer. The longer answer, we actually, for Juneteenth, the StockCharts office will be closed. We won't be doing any new programming on that day, but our live programming, we will be creating a special video where I will ask some people, what does a good-looking chart mean to you? And give them, have them give a more detailed answer. I will fill in a little more details on the short answer I just gave you there. So that'll be on June 19th. Look for that special edition of the Final Bar. Next question. Where can I find the percent from moving average indicator? One of my guests this week, I actually forget who, I think it was Adam Turnquist who showed this indicator. If I remember right, it's a bit of a blur, but I'm pretty sure that was it. That to get that indicator, he showed how the S&P was 10% above its 50-day moving average. The way you do that is actually go to our ACP platform. Let me get there. So if we go to StockCharts ACP, I was just going through this in detail with Grayson Rose, by the way. We have our Deception Pass product release coming here very soon. It includes some really cool features on ACP. I can't show you much of them yet because they're still in a development environment. We have our developers banging away on them and people like me going in and trying to break it to see what you guys might do on the chart first before we go release it to everybody. But there's some really cool stuff coming, and also a preview of the new version of Sharp Charts. a new market carpet, some really cool stuff. I cannot wait to show you very, very soon, but not quite yet. That indicator is called distance from moving average. It's a really fantastic indicator that allows you to set the moving average period. You can set the type of moving average, and you can actually have this really beautiful visualization that just shows you where the price is relative to a key moving average that you might want to do, and you can click and drag and do all sorts of cool stuff with that. If you don't see that indicator, what you need to make sure that you do is add the StockCharts Advanced Indicator Pack. And in ACP, go to the right column, go to the very bottom. There's this little plug, which are all of our plugins. We have a series of premium plugins, like the Chaikin plugin. Larry Williams has a plugin. Arthur Hill, the Simpler Trading folks, and others. Market Gauge have some really cool premium plugins you may want to look at. But we have some free plugins as well, including the StockCharts Advanced Indicator Pack. And it includes that indicator along with others. So if you don't see that available, you just have to add that on there. It's free to StockCharts members, and I would encourage you to do so. Next question, why can't I find bullish percent indexes for industry groups? And can I just take a step back and say thank you guys all for these really thoughtful questions. I really appreciate what you guys are asking about. You're digging into the platform and trying to answer questions, and I'm thrilled that you're doing it. You're asking about the bullish percent indexes. I refer to the S&P's bullish percent index and also sometimes the NASDAQ bullish percent index, but we have others. If you go to Charts and Tools on our website, go to the right column and go down to where it says Market Summary is a good place to find them. Now we start with a chart view. I'm going to switch this to table view because it's a little easier to get down to the bottom here. You'll see all these different sort of big picture things you may want to know about. But if we go further down, we'll get to cryptos, we'll get to currencies, and then we have market breadth, and then we have bullish percent indexes. These are all the bullish percent indexes that we currently track. And the top ones are some of the big ones like the S&P, the NASDAQ 100. You can see we have NYSE bullish percent indexes for Toronto. And then we have a series of sector ones, and then some groups like gold miners and transports and others. What you're asking for is how come we don't drill down further and do the industry groups? Here's the problem. The NYSE has 2,000 some stocks, and so the bullish percent index, what percent of them are a certain value has meaning, right? When you're looking at consumer discretionary, there's 100 some stocks in that I would imagine, and so there maybe 80 to 100 would be my guess. So there's a bunch of names in there. So looking at what percent have a certain characteristic is meaningful. The problem when you get to something like transports or even something like gold miners, there just aren't a lot of gold miners to include. And so if you look, it's a pretty clunky chart because I think there's only 10 or 11 stocks that we have, or maybe 12 at most in this group. So you can see it's this really weird kind of gross chart because it's spotty because there's not enough names in here to have a smooth data series. This is why with industry groups, a lot of times it'll be a very small number of names. A lot of them will be very illiquid. So what their point and figure chart says may not be that valuable. So while it might be helpful to know for semiconductors or for, software or home builders, what percent are in it. Two issues. Number one, you have the liquidity issue. Number two, you have a homogeneous group, right? All the home builders kind of look the same. And so the indicator is going to kind of go from 100% to 0% back, and there's not going to be a lot of information there. So we have gone through this data over time and found the bullish percent indexes that we feel comfortable showing on there. Gold miners, for me, transports are not particularly helpful, I'll tell you honestly, because I just don't think there are enough names in there. Telecoms would be the same thing. But for the bigger groups of stocks, a bigger group of liquid stocks, that's where the bullish percent index could be really valuable. Having said that, could we at some point allow you to create your own bullish percent index from your own group of stocks, or a custom defined list, members of an ETF? Yeah, and the reason why I would say that's something we could do is because it's on a big development list, and I've made sure that it's on there. I would love to do that. At some point, I'll be able to announce that that's ready. Not today, though. Final question, and then we'll have to wrap it for the day. Why are bar charts better than candlestick charts? And I love the simplicity of your question. I love the fact that you're somehow implying that one of them may be better than the other, and I think you could probably guess my answer. I don't think one of them is better than the other. I think you had a longer question. I boiled down into that, to be honest. But what you were asking about was basically why I use bar charts much more often than candlestick charts. For me, it's how you think which one is more valuable than the other, right? I learned technical analysis using candlestick charts because at the time I was working with a lot of traders on institutional trading desks in New York and Connecticut. So I'd go up to the desk at UBS, which is this big warehouse of like thousands of traders and salespeople. I'd go to all the different trading floors in New York City and then around North and South America as well. And what I found working with short-term traders, they often use candlesticks charts because it was a really good way of visualizing the dynamics, right? Candlestick charting is a very visually rich data set. And I vividly remember going to, I think it was Nomura or Mitsubishi Bank, I forget what Japanese bank in New York, but I walked in and they were all using just candle charts and Ichimoku charts. Those were the two things. That was it. No other indicators, and they swore by them. And it was fascinating talking to them about how they were using those different techniques. But for me, when I'm looking at a 2-year daily chart, the candlestick visualization doesn't really add much because I consider that more of a short-term indication of supply and demand from day to day. So when I'm looking at something like Electronic Arts over 2 years, I'm looking at a bar chart because for me, that's good enough. But you will find, if you pay attention, I often switch to I call this chart candle focus, and it's basically zooming into the last month or 2 months and just looking at the candle patterns. Because for me, recognizing that Electronic Arts has these big upper shadows is meaningful, right? Recognizing a bullish engulfing pattern or a bullish harami pattern, a bullish piercing line, which is this particular pattern, has meaning to me, but in a very particular context. So depending on what questions I'm trying to answer, I will go back and forth between bars and candles. The right answer for you depends on what you are trying to accomplish. I would encourage you to experiment with both. Also, spread it out a little bit. Look at things like Renko charts or point and figure charts. There are a lot of different ways to visualize price data. Use the techniques that are going to help you make better decisions for your portfolio. We got to wrap the show, folks, and go to the 3 in 3. Let's talk about 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. I'm inclined on a Friday as we're wrapping the week to sort of take a step back. It's a natural time to just look back and think about what is happening. I'm getting ready to write my weekly flight plan from my Market Misbehavior Premium members in a little while, and I was drawn to this chart of the S&P 500 going back to the 2020 low, all using Fibonacci retracements and just looking at the structure of the markets. That's how I kind of think of this. Going back to the March 2020 low, the January 2022 high, what have we done between those levels, and how can Fibonacci retracements help me identify or ideally anticipate where we might get some turns? If you ask me why 4,300 to 4,325 is such an important level, I think this chart probably tells that story maybe better than others that we've shown so far today. Take the January 2022 high, take the October 2022 low. You'll see 4,000 represents a 38.2% retracement. That was that big major high in the fourth quarter of last year. We are now at the 61.8% level, 4310, which lines up beautifully with the August 2022 high. That suggests two things. Number one, the level we're at is pretty important. Also, I should note the 50% retracement. I didn't highlight that, but the February high lines up pretty well around 4150. We get above 4325. We have eclipsed that last level, and the Fibonacci analysis tells us we are probably going to go on to all-time highs. Chart number 2 is looking at the energy sector. Thinking a lot about mean reversion right now, right? Is the mega cap growth trade over, right? Are these names like Meta and others that have had the run, that have really moved the market higher in 2023? Is there more upside to that trade? Are things like energy and financials, which have been underperforming, starting to show signs of life? I think June so far has been a pretty good month for the energy sector. You've seen this bounce from a low at the end of May. We've actually rotated higher, but I would need to see a little bit more, and that's what I'm drawn to looking at this chart today, right? Getting above the 50 and the 200-day moving average, the momentum getting more bullish, the relative strength starting to turn higher. These are all things that may be starting to happen in June, but I would want to see through the end of the month if we continue to go higher. I think the energy sector might be a really important one to watch as a potential area of leadership. Finally, speaking of the large cap growth trade, charts like Meta, what makes them so constructive? Again, we have a special coming up on the Juneteenth holiday to dig into that a little more detail, but I'm using an indicator called Zigzag, which is a simple visualization just picking on percent moves and highlighting a line which shows you the 5% moves and connecting those highs and lows. Higher highs and higher lows are an uptrend. That is what we are seeing with the chart of Meta Platforms. Folks, that's a wrap for this week and a wrap for the Final Bar. Thank you so much for joining us every weekday after the close. Check our YouTube channel for all of our previous interviews and episodes. For StockCharts in Redmond, Washington, I'm Dave Keller. Have a great weekend. We'll see you on Monday.